Hi and welcome to another edition of Weekly Market Report by tradersclub.co.uk. As per usual, very quick disclaimer. Anything that we discuss here is available in a public domain and therefore it should not be considered to be advice for your trading or investment. We are simply sharing the information for the benefit of the club members. Okay, I'll try and keep this report very brief. S&P, we had a bit of a consolidation after reaching a new highs around 1700 level. Initial sell-off was actually supported by this previous high at 1674.21, and Friday trading created a bullish hammer candle. I think markets are waiting in general. News and releases which are due next week on 1st and 2nd of August, mainly in this case non-farm payroll, but if you're talking about European indices and currencies, Bank of England and ECB interest rate decisions. So currently support is clearly defined here at 1674.21, followed by 1663, which is 20 period moving average on daily, and obviously 1654 before we attempt to retest this 50 period moving average on 1644. So quite a number of significant support levels on the way down. Resistance on the way up, it's around here, 1698, 1700 level. Anything above that is uncharted territory. So obviously we have opening up Bollinger Bands, potentially targeting 1705, 1713, 1724. Take your pick. It depends on market reaction on Friday after the non-farm payroll. Indicators like MACD are quite overextended on the way up. Histogram is kind of falling behind, but it did not flip just yet on the downside. And stochastics is in overbought territory above 80. These are not the actual triggers to short this market. This is clearly defined uptrend with creation of higher highs and higher lows. However, markets are extended on the way up. European markets, I'll cover FTSE. FTSE was kind of stuck in this really ugly trading range. Actually was quite good if you're a technical trader and you can trade this 100-point kind of move. It was between 1654 and 1660. It was just ranging there for quite some time, and finally we had a bit of a pullback towards the end of the week. However, we would need to wait and see the reaction Monday, Tuesday, and obviously on Thursday in particular. This appears to be a breakout above previous resistance, which is this high. And now we are retesting it from a basically point of view that this is a newly found support rather than this previous resistance. Below this 65.33 level, we have a cluster of 20 and 50 period moving averages on 6507 and 6465, which will act as a logical point of support as well. On the way up, if we see a breakout above 6662 or 6660 and a daily close above this level, then it's quite possible that we could target further resistance around 67, 68, 6875. Some of the traders would see this as potentially the beginning of head and shoulders formation, but in order for us to confirm that, we would need to see quite a significant sell-off and a loss below that this kind of neckline level before that can be confirmed as a topping head and shoulders. At the moment, this could be a lower high, or it could be just a consolidation phase before we move higher. We don't know. MACD, it's overbought, and same as stochastics as well. Here we go. Gold, clearly defined downtrend, previous support, now newly formed resistance. Anytime we had a formation of this consolidation, sideways or rising wedge formation, they broke on a downside. These are quite bearish formations. Resistance on the way up, it's clearly located here at 1348, 1355. 1364, 1400 purely because it's a round number and this falling resistance trend line. Support on the way down at 1300, 1279 and 1250 levels. Stochastics is overbought. However, if we look at the gold on longer term time frames like monthly and weekly, we could see that it's actually quite seriously oversold. Very similar situation with silver. Silver is trading very closely to this psychologically important 20 level. The breakout above 2059, which is this current high, would potentially target 2084, 2250, even 23 levels. Alternatively, if we drop lower, support could be found anywhere around here, 1980, 1922, 1880, all the way down to 1817. This can be seen as a kind of falling resistance trend line as well. So this needs a further clarification. Stochastics is overbought. WTC, TIC, crude oil. This inverse head and shoulders formation played out really well, especially when we saw the breakout above 99. These two red lines are previous highs, dated a couple of years ago. This one is actually at 110.55. A pullback would be healthy, so support on the way down would be around here at 104, which is 20 period moving average and daily. Alternatively, we can take the fib retracement from this low to this high. That will give us 102.72 or 181. Even this 99, 98, 89 level could act as a point of support or a level of support, because that's 50 period moving average and a cluster of these previous highs as well. However, I would be surprised if we see such a deep pullback. It is overbought. Given enough time, these indicators will go down to neutral, and potentially we could see a creation of the higher low. And assuming that the trend with dollar and geopolitical risk stays as it is, supply and demand stays the same, this particular commodity appears to be quite bullish, so clearly defined uptrend. And this is the chart of US dollar. Those of you who are trading currencies, you can clearly compare it to euro dollar, cable, even dollar yen, dollar Swissy, and you would see that when FOMC was talking about tapering, the markets kind of sold off and rallied as a result of that. When we are talking about continuation of a accommodative policy, we are seeing a pullback in dollar, therefore rally in euro dollar and cable. So I think markets are pulling back and attempting to reach these quite a significant support levels. 200 period moving average on daily is around 81.48. We have a full fib retracement from this low to this high, just below that level at 81.23. And then we are kind of attempting to go back down to this very important psychological level, 80, 81.07, 80.50 and 80, which we tagged for many months in the past, and it was very tight consolidation range. If the FOMC changes their tone, depending on the non-farm payroll numbers on Friday, this dollar index could potentially react to that, and we could see either a spike higher. In that case, a resistance on the way up would be 81.94, followed by 82.60, which is this 50 period moving average, and 83.11 before we attempt to go higher. So analysts are divided on this one. Some people are saying dollar weakness going forward. Some other analysts are saying dollar strength, but at the end of the day, it depends on FOMC. You can see that our stochastics indicator is oversold, and that the price is actually creating higher low. So potentially some bullish traders could see this as an opportunity to trade this index higher, assuming that everything stays as expected with FOMC and non-farm payrolls. Okay, hopefully you enjoyed it, and I'll talk to you soon.